If you're looking at buying a business and you have no idea what it's actually worth, or more importantly, what a lender is going to say it's worth, this video is going to break it down for you step by step. I'm Josh Kim, founder of Acquisition Vault. I've personally closed 3 healthcare business acquisitions before I turned 21, all funded through 7(a) loans. The number one thing I learned about going through that process is that valuation is not about what a business earns. It's about what number a bank is willing to put a loan against. So today I'm going to walk you through exactly how to value a small business as a buyer, what SDE actually means and why it matters, how lenders use something called DSCR to decide whether or not your deal gets approved or not, and the mistakes I see buyers make all the time when it comes to these numbers. 3 things, and by the end of the video, you're going to understand valuation the way the lenders see it, not just the way the textbook explains it. So let's start with the basics. If you go online and search how to value a business, you're going to come across a few different methods: discounted cash flow analysis, comparable company analysis, comparable transaction analysis. And if you don't have a finance background, it can feel overwhelming pretty quickly. But here's the thing though, if you're buying a business in the range of what most clients are looking at, which is anywhere from $500,000 up to $5 million in purchase price, you really only need to care about one of these methods, and that's the comparable transaction analysis. Discounted cash flow is what investment bankers use on massive companies. They're projecting future cash flows and discounting them back to present value. That doesn't really apply for smaller companies, and that's not what we do at this level. Comparable company analysis looks at publicly traded companies and their multiples, which again has almost nothing to do with small businesses you and I are looking at. What actually matters for you as a buyer is comparable transactions, meaning what have similar businesses actually sold for recently. That's the data point that tells you whether or not the asking price on the deal you're looking at is in the right ballpark or way off. But before you can even compare your deal to other transactions, you need a standard measurement of what the business earns, and that's where SDE comes in. SDE stands for Seller's Discretionary Earnings, and it's the single most important number in your entire deal. It's the number that determines the valuation. It's the number that your lender is going to underwrite against. And if you get it wrong, your deal either falls apart or you overpay. So what is SDE? At its core, it's the adjusted cash flow of a small business, what the owner actually takes home. You start with the business's net income, and then you add back in the owner's salary, because as a buyer stepping into that role, you're going to decide what you pay yourself. You add back any personal expenses the current owner is running through the business. Maybe they got a car payment running through it, personal travel, family cell phone, things like that. You add back interest, depreciation, amortization, and any one-time or non-recurring expenses. What you're left with is a normalized picture of the true economic benefit of owning that business, and that's the number we build everything off of. Now, here's why it matters from a buyer and a lender perspective specifically. When you're buying a business with an SBA 7(a) loan, the SBA lender is not just looking at SDE to determine valuation. They're using it to figure out whether the business generates enough cash flow to pay back the loan. And the metric they use for that is called DSCR, which stands for Debt Service Coverage Ratio. This is one of the most critical numbers in the entire underwriting process, and I'm amazed at how many buyers have never ever heard of it before they came to me. DSCR is calculated by taking the business's cash flow, typically a version of SDE, adjusted for a market rate owner's salary, and dividing it by the total annual debt service, meaning your loan payments. Most SBA lenders want to see a DSCR of at least 1.25, which means the business needs to generate at least $1.25 in cash flow for every dollar in debt payments. Some lenders want 1.3 or higher depending on the industry. Bigger deals sometimes require higher thresholds, but here's where it gets real for buyers. If the DSCR doesn't hit that threshold, the lender is going to either decline the deal, reduce the loan amount, or require a larger equity injection from you. So the valuation isn't just a negotiation number between you and the seller. It has to be a number the bank can actually approve based on cash flow math. Let me give you a real example of how this works in the end. Let's say you find a home service business that listed at $1.2 million. The seller says the business does $350K in seller's discretionary earnings. The first thing you do is you verify that number, you pull tax returns, the profit and loss statements. Ideally, you hire a quality of earnings accountant to confirm the add-backs are legitimate. And let's say after the QE comes back, the real SDE is actually closer to $300,000. Now you look at comparable transactions for the home services businesses in that revenue range, and the comps are showing that similar businesses have sold at roughly 2.5 to 3 times the seller's discretionary earnings. So at $300,000 in net income, the supporting valuation range is somewhere between $750,000 and $900,000, not the $1.2 million the sellers ask. But here's the second layer that most buyers miss. Even if you negotiate the price down to $850,000, the lender still has to approve on that number. So let's run the DSCR. An SBA loan on an $850,000 deal, assuming the bank finances 90% of it, means a loan of about $765,000. On a 10-year term at current SBA rates, your annual debt service is going to be roughly $105,000 to $110,000 a year. Now you take the $300,000 in SDE, subtract a reasonable owner salary, call it $880,000. You've got $220 in adjusted cash flow available to service the debt. Divide 220 by 110 in debt service, and your DSCR is right around 2x, which is strong. Lender's going to be comfortable with that. But if the SDE had been $200,000 instead of $300,000, and the seller was asking $1.2 million, the math completely falls apart. That's a deal that's just never going to get done. So once you've established the seller's discretionary earnings, found your comparable transaction multiples, and confirmed that DSCR works, there are a couple more things to consider. If the deal includes significant tangible assets, including real estate, specialized equipment, vehicles, those are typically valued separately and are added to the purchase price. Real estate in particular almost always gets its own appraisal and off its own loan. You can combine them into a single loan if you're buying the business and the real estate together, but sometimes they're split up. On the other side, if you're assuming any liabilities as part of the deal, they get subtracted from the price. Most acquisitions at this level are structured as asset deals, so liability assumption is less common, but it does come up. It's like assuming a vehicle lease, honoring accrued employee PTO, and those adjustments, they all need to be factored into your total deal cost. The other thing I want you to understand is why multiples vary so much depending on size and type of business. A business doing $200,000 in SDE might trade at 1 to 2 times earnings, while a business doing $800,000 in SDE in the same industry might trade at 3 to 3.5 times. And the reason is risk. Smaller businesses tend to be more owner dependent, as the owner's doing the sales, managing the team, and handling key client relationships. A buyer stepping in has to replace all that, and there's real transition risk. Larger businesses typically have management in place, diversified revenue, lower customer concentration, and more predictable cash flows. Lenders see that and they're willing to finance at higher multiples because the risk of the business declining after the sale is lower, and there's more capital competing for those deals. You've got more sophisticated buyers, sometimes even private equity groups bidding up prices. At the lower end, it's mostly individual buyers using SBA financing, and the pool of qualified buyers is smaller, which keeps multiples lower. A few things that can push a multiple higher or lower regardless of size. Growth rate matters a lot. If the business is growing steadily 25 to 15% over year, a buyer can justify paying a premium because the earnings are trending up. Customer concentration is also a big one. If 2 or 3 customers represent more than 30 to 40% of revenue, that's a major risk factor and lenders will flag it. Industry stability, recurring revenue, how systematized the operations are, all these influence where the multiple range a business lands. And from a lender's perspective, they're looking at all this too, not just the SDE number in isolation. So let me give you the framework one more time because this is what we need to walk away with. Step 1, calculate the SDE and make sure those numbers are verified, ideally by a QE accountant. Step 2, find comparable transaction data for similar businesses in the same industry and revenue range. You can find this on sites like BizBuySell or work with an advisor who has access to multiple private transaction databases. Step 3, apply the multiple to get to your valuation range. Step 4, run the DSCR to confirm the deal is financeable at that price, because a valuation that the lender won't fund is just a number on paper. Step 5, account for any assets that are being transferred or liabilities being assumed. If you do those 5 things, you're going to walk into negotiations with a clear, defensible number. And more importantly, you're going to know before you ever submit an LOI whether or not a deal can actually get funded. That's the difference between the buyers who close and the buyers who waste months chasing deals that were never going to work in the first place. If you're in the process of evaluating a deal right now and you want help figuring out whether the numbers actually work from a financing perspective, I do free 30-minute strategy calls where we walk through where you are today, including your specific situation, the deal you're looking at, the capital stack, and which lenders are going to be the right fit for your deal. You can book all that at acquisitionvault.com. I'll see you in the next one.